Are you approaching retirement, or already collecting your pension? Then stop everything and listen carefully, because what's coming in 2025 could completely transform your retirement income. The Department for Work and Pensions is preparing some of the biggest pension updates in years, changes that could put hundreds, even thousands of extra pounds into your pocket every single year. We're talking about a record state pension increase under the triple lock guarantee, crucial national insurance top-up deadlines, new workplace pension reforms, and tax changes that will reshape how retirees manage their savings. Whether you're 55, 65, or already retired, the next few minutes could be the difference between a comfortable retirement and struggling to make ends meet. Welcome back to the channel. If you're new here, we make complex financial news simple, helping you understand what's really going on with your pensions, benefits, and retirement income. And today's story is absolutely crucial. Make sure you hit that subscribe button and turn on notifications, because pension rules are changing fast, and one missed update could mean losing thousands of pounds in benefits. Now, let's get into the biggest pension story of 2025, the triple lock boost. The UK state pension is getting a major increase from April 2025, thanks to the triple lock mechanism. This guarantee ensures that the state pension rises each year by whichever is highest inflation, average earnings growth, or a minimum of 2.5%. This year, earnings growth has outpaced inflation, meaning pensioners will see one of the biggest uplifts in years. Early forecasts suggest that the full new state pension will rise to around £230 per week, up from £221.20, marking an increase of roughly £470 per year for those receiving the full amount. For those on the older, basic state pension system, that's people who reached state pension age before April 2016, payments are expected to increase to around £176 per week. When you add it all up, that means someone on the full new state pension will now receive close to £12,000 a year from the government alone. It's a solid foundation for retirement, but not everyone receives the full amount. And this is where it gets incredibly important. Your state pension depends entirely on your national insurance record, specifically how many qualifying years you've built up. Under the new system, you need 35 full qualifying years to receive the full amount, and at least 10 years to receive anything at all. Each missing year reduces your pension proportionally. Many people are shocked when they check their records and discover they are missing years, often due to time spent raising children, living abroad, or periods of unemployment. The good news: you can fill these gaps by buying additional national insurance years. This is one of the smartest financial moves you can make. For example, if you've only got 30 years on your record, you're missing 5 qualifying years. That shortfall could reduce your annual state pension by around £14 every single year. But right now, it costs roughly £824 to buy back 1 year of contributions. So, for around £4,000, you could increase your pension by £14 per year for life. You'd earn back your investment in under 3 years, and after that, every extra pound is profit. However, there's a critical deadline you must know about. The government has temporarily allowed people to buy back national insurance years as far back as 2006. But that window closes in April 2025. After that, you'll only be able to go back 6 years, meaning any older gaps will become permanent. This deadline could be worth tens of thousands of pounds to your lifetime pension income. If you've ever worked part-time, taken career breaks, or lived abroad, you must check your national insurance record before April 2025. Visit the government's website, check your forecast, and consider whether buying missing years makes sense for you. Now, let's move on to workplace pensions, another area seeing major reform. Automatic enrollment has been one of the government's most successful policies in encouraging people to save for retirement. Currently, workers aged 22 or older who earn at least £10,000 per year are automatically enrolled in a workplace pension, with a minimum total contribution rate of 8% of qualifying earnings. But in 2025, this system is changing dramatically. The government plans to lower the minimum age from 22 to 18, meaning millions of young workers will start saving earlier. There's also a proposal to remove the lower earnings limit, currently £6,240, so pension contributions will be made from the very first pound you earn. This is a huge win for lower income and part-time workers, who were previously missing out on pension contributions for a portion of their earnings. These reforms will allow more people to build stronger retirement savings earlier in life, taking full advantage of compound growth. The earlier you start saving, the more powerful your returns become. A worker who starts contributing at 18 instead of 22 could end up with tens of thousands of pounds more by retirement, without paying a penny more each month. Let's talk now about access to pensions and how the rules are shifting. Since 2015, pension freedoms have allowed people aged 55 and over to flexibly access their defined contribution pensions. But from 2028, the minimum age for accessing your pension will rise to 57. So if you're between 55 and 57 right now, the current rules still apply to you, but future retirees need to plan around this change. When you access your pension, you can typically take 25% as a tax-free lump sum, with the remainder subject to income tax. This opens up powerful tax planning opportunities, but only if you manage withdrawals carefully. Many retirees fall into the trap of taking their entire pension pot at once, only to face a huge tax bill. Instead, spreading withdrawals over several years can keep you in a lower tax bracket and dramatically reduce the total tax paid. For example, someone with a £200,000 pension, who takes £25,000 a year over 8 years, could save tens of thousands in taxes compared to cashing it all out in one go. Smart planning here can make your money last longer and work harder for you. And speaking of tax, here's a major change that arrived in 2024, but continues to shape the pension landscape: the abolition of the lifetime allowance. Previously, there was a cap around £1.73 million on how much you could accumulate in pensions without facing hefty tax charges. That limit has now been scrapped, freeing savers to build as large a pension pot as they want. However, two new limits have replaced parts of the system: the lump sum allowance and the lump sum and death benefit allowance. The first caps the total tax-free cash you can take across all pensions at £268,275. For most people, this won't be an issue, but for wealthier retirees, it's important to plan withdrawals carefully to avoid unexpected taxes. Now, let's shine a light on one of the most underclaimed benefits in the UK: pension credit. This vital DWP payment tops up the income of pensioners on lower earnings, ensuring they have enough to live on. It's currently worth around £218 a week for single pensioners, and £332 for couples. But here's what many don't realise: claiming pension credit also unlocks a long list of other benefits. You could get help with housing costs, a reduction on council tax, free TV licenses for those over 75, and even heating assistance through the Warm Home Discount Scheme. Despite all that, over 850,000 eligible pensioners still don't claim it. Many assume they won't qualify because they own a home or have modest savings, but that's often not true. If your weekly income is below the threshold, you could qualify. Even £10,000 in savings is only treated as generating an extra £1 per week per £500, meaning you can still qualify with reasonable savings. Check your eligibility, it could be worth thousands of pounds every single year. Now let's talk about something many people don't consider: until it's too late, what happens to your pension when you pass away. Pension death benefits are more generous than ever before. If you die before age 75 and haven't drawn from your pension, your beneficiaries can usually inherit it tax-free. If you pass away after 75, they'll pay income tax only when they make withdrawals, at their marginal rate. Crucially, pensions typically sit outside your estate for inheritance tax purposes, meaning they aren't subject to the 40% inheritance tax that applies to estates over £325,000. This makes pensions one of the most tax-efficient tools for passing on wealth. Some retirees even choose to draw income from other sources first, leaving their pension untouched for as long as possible to preserve this advantage. For those still working, it's also important to understand pension tax relief. The annual allowance remains at £60,000 for 2025, the maximum you can contribute to pensions in a year while still receiving tax relief. Basic rate taxpayers receive 20% relief automatically, while higher and additional rate taxpayers can claim even more through their tax return. This means a higher rate taxpayer can put £100 into their pension at a net cost of just £60. Salary sacrifice schemes can make it even better, allowing you to reduce your salary in exchange for higher pension contributions, saving both you and your employer on national insurance. As we look at the full picture of UK pensions in 2025, one thing becomes clear: while the system is complex, it remains incredibly rewarding for those who engage with it. The triple lock continues to protect pensioners from inflation. The opportunity to buy missing national insurance years offers one of the best guaranteed returns available anywhere. The workplace pension reforms will help millions build stronger retirement pots earlier in life. And the end of the lifetime allowance removes one of the biggest barriers for savers planning ahead. But with all this opportunity comes responsibility. There are deadlines, tax traps, and eligibility rules that can make or break your retirement finances. Don't wait. Check your national insurance record today. Review your workplace pension and consider increasing your contributions, especially if your employer matches them. If you're nearing retirement, start thinking about when and how you'll draw your pension to minimize tax. And if you're already retired, make sure you're not missing out on pension credit or other DWP benefits you're entitled to. The truth is, these next few months leading up to April 2025 could be the most financially important of your retirement. Act now, and you could lock in thousands of pounds of additional income for life. Miss these opportunities, and you might leave money on the table that you'll never recover. So take action, check your pension forecast, confirm your NI record, and don't let the April deadline slip past unnoticed. Because your financial comfort in retirement isn't just about what you've saved, it's about what you know and how you use it. Thank you so much for watching. If you found this breakdown helpful, please give it a thumbs up and share it with friends or family members who might benefit. The more people understand how these changes work, the more retirees can secure the income they truly deserve. Leave a comment below if you have any questions about your situation, and we'll do our best to point you in the right direction. Until next time, take care, stay informed, and start planning for the secure and comfortable retirement you've earned.